The biggest mistake I see investors making? Ignoring 40% of the world's investment opportunities. While SCHD delivers an impressive 4.05% yield here at home, combining it with international ETFs like IEFA and VWO unlocks even greater income potential most US-only investors miss entirely. In this video, I'll show you the perfect balance between SCHD and international ETFs that could transform $100,000 into over $5 million while providing growing monthly income exceeding $11,000. If you're serious about building generational wealth, this global ETF strategy might be the most important portfolio adjustment you'll ever make. The US isn't the only game in town, and I'm about to show you exactly how to capitalize on what the rest of the world has to offer. Here's everything I'll cover in this video. Why limiting yourself to just US stocks could be costing you thousands in potential income. How international ETFs are currently yielding up to 3 times more than US ETFs. The perfect allocation between US, international developed, and emerging markets that maximizes both growth and income. A simple 4 ETF portfolio that gives you exposure to over 8,000 stocks worldwide. And at the end, I'll show you how this strategy could transform $100,000 into more than $5 million over time while providing growing monthly income. The problem? The all-American investing trap. Does your portfolio consist entirely of US stocks? You're not alone, but you're missing 40% of the world's investment opportunities. The US makes up just 60% of the global stock market. Here's what most investors don't realize. International stocks pay significantly higher dividends. According to April 2025 data, VOO, S&P 500, 1.39% yield. IEFA, International Developed, 3.14% yield. VWO, Emerging Markets, 3.15% yield. International stocks are paying more than double the dividends of US stocks. If you're ignoring international markets, you're literally leaving money on the table. Yes, US stocks have outperformed recently, but markets move in cycles. That's why global diversification is crucial for long-term success. So, what's the solution? I call it the Global Growth and Income Portfolio, and it consists of just 4 ETFs that give you exposure to over 8,000 stocks worldwide. Here are the 4 ETFs with the latest data as of April 2025. VOO, Vanguard S&P 500 ETF, US Large Cap. Yield, 1.39%. Expense ratio, 0.03%. 5-year performance, 96.17%. IEFA, iShares. Core, MSCI ETH ETF, International Developed Markets. Yield, 3.14%. Expense ratio, 0.07%. 5-year performance, 51.91%. VWO, Vanguard, FC Emerging Markets. ETF, Emerging Markets. Yield, 3.15%. Expense ratio, 0.07%. 5-year performance, 27.44%. SCHD, Schwab. US Dividend Equity ETF, US Dividend Stocks. Yield, 4.05%. Expense ratio, 0.06%. 5-year performance, 57.42%. Let me break down why each of these ETFs deserves a place in your portfolio. Starting with VOO, it tracks the S&P 500, giving you exposure to the 500 largest US companies with a rock-bottom expense ratio of 0.03%. Over the past 5 years, VOO delivered a 96.17% return. It's heavily concentrated in technology, with electronic technology and technology services making up about 40% of the fund. The top 10 holdings represent 33.58%, including Apple, Microsoft, and NVIDIA. Next is IEFA, covering developed international markets across Europe, Japan, and Australia. The latest data shows it holds 2,614 stocks, with finance making up 24.84%, much higher than VOO's 15.93% financials allocation. With a 3.14% yield, IEFA provides more than double VOO's income. VWO gives you exposure to emerging markets like China, India, and Taiwan. It holds an incredible 4,832 stocks, with Asia representing 78.07% of the portfolio. While VWO has underperformed recently, Its 3.15% yield and exposure to faster-growing economies provide important diversification. Finally, SCHD focuses on high-quality U.S. dividend stocks, offering a generous 4.05% yield. Unlike VOO, SCHD's top sectors include consumer non-durables, 17.03%, health technology, 14.70%, and energy minerals, 14.47%. SCHD delivered a 57.42% return over 5 years while maintaining its high yield, an impressive combination of income and growth. Now that we understand each ETF, let's talk about the perfect allocation. Based on my research, here's what I recommend. 40% VOO, US large cap. 25% SCHD, US dividend. 25% IEFA, international developed. 10% VWO, emerging markets. This gives you a 65% allocation to the US and 35% to international markets, which is a good balance between home country bias and global diversification. But wait, before I walk through the numbers to show you how this portfolio could perform, I want to mention something important. If your goal is even more income, you could consider adding SCHY, the Schwab International Dividend Equity ETF. According to the latest data from April 2025, SCHY offers a generous 4.03% yield with a low 0.08% expense ratio. It holds 101 high-quality international dividend payers across Europe, 59.53%, Asia, 17.93%, and Oceania, 12.28%. So if income is your primary goal, you could adjust the allocation to 35% SCHD, US dividend, 30% VOO, US large cap, 20% IEFA, international developed, 10% SCHY, international dividend, 5% VWO, emerging markets. This income-focused variation would significantly boost your portfolio's yield while maintaining global diversification. Now, let's get to the exciting part, the numbers. Let me show you what this portfolio could do for you. Let's look at the incredible wealth-building potential of our global growth and income portfolio, with Harry investing $100,000 initially. First, let's be clear about how we arrive at our 2.53% blended yield. Remember our recommended allocation, 40% VOO with 1.39% yield, 0.56%, 25% SCHD with 4.05% yield, 1.01%, 25% IEFA with 3.14% yield, 0.79%, 10% VWO with 3.15% yield, 0.32%. These combine to give us our 2.53% blended portfolio yield. But here's the key. Instead of just focusing on this initial yield, we're going to harness the full power of dividend reinvestment. With dividend reinvestment and assuming an 8% annual total return, which is actually conservative for a globally diversified portfolio, here's how Harry's initial $100,000 investment could grow. Year 5, $146,930, generating about $3,717 in annual dividends. Year 10, $215,890, generating about $5,462 in annual dividends. Year 20, $466,100, generating about $11,792 in annual dividends. Year 30, $1,006,270, generating about $25,458 in annual dividends. That's over $1 million from a single $100,000 investment with all dividends reinvested. But we're just getting started. Now let's see what happens when Harry combines 3 powerful forces: initial investment, dividend reinvestment, and regular monthly contributions of $1,000. Year 5, $181,774, generating about $4,599 in annual dividends. Year 10, $310,185, generating about $7,848 in annual dividends. Year 20, $679,770, generating about $17,199 in annual dividends. Year 30, $1,572,844, generating about $39,794 in annual dividends, or $3,316 monthly. And if Harry really wants to accelerate his wealth building by investing $2,000 per month while reinvesting all dividends, Year 5, $263,448, generating about $6,665 in annual dividends. Year 10, $458,380, generating about $11,597 in annual dividends. Year 20, $1,034,060, generating about $26,161 in annual dividends. Year 30, $5,239,648, generating about $132,564 in annual dividends, or $11,047 per month. Look at that last example closely. In year 20, Harry's portfolio is generating $26,161 in annual dividends. But by year 30, just 10 years later, it's generating $132,564 in annual dividends. That's a massive 5 times increase in just a decade. This demonstrates the exponential growth phase that happens when dividend reinvestment, regular contributions, and dividend growth all work together. There it is. Over $5.2 million from an initial $100,000 plus $2,000 monthly investments with all dividends reinvested. And that portfolio would be generating about $11,047 per month in dividends, potentially enough to retire on dividend income alone while still having the $5.2 million principal intact. But what if Harry wanted to maximize his income even further? Let's look at our income-focused portfolio variation with its higher initial yield, around 3.12% blended. With the higher yield portfolio and the same $2,000 monthly investment approach, Year 5, $266,775, generating about $8,323 in annual dividends. Year 10, $471,315, generating about $14,705 in annual dividends. Year 20, $1,096,650, generating about $34,215 in annual dividends. Year 30, $5,559,810, generating about $173,465 in annual dividends, or $14,455 monthly. That's the power of what I call the global dividend snowball. When you combine global diversification, dividend reinvestment, regular contributions, and dividend growth, you create an unstoppable wealth-building machine that can eventually generate massive passive income. Couldn't I just invest in US stocks? Let's compare. VOO alone delivered 96.17% over 5 years. Impressive. But it yields just 1.39%, while our global portfolio yields 2.53%. In dollar terms, Harry's $100,000 generates $1,390 annually with VOO versus $2,530 with our global strategy, an extra $1,140 per year. Plus, combining assets that don't move in perfect sync, US and international stocks, reduces overall volatility while maintaining strong returns. This smoother ride helps you stay invested during market turbulence, critical for long-term success. So there you have it, a simple 4 ETF global growth and income strategy that could potentially transform $100,000 into over $5 million while providing growing monthly income of more than $11,000 per month. Remember, the key to investment success isn't about timing the market or picking the next hot stock. It's about building a diversified portfolio aligned with your goals and sticking with it through market cycles. If you found this video helpful, please hit that like button and subscribe for more practical investing strategies. And if you're already implementing a global approach to your portfolio, I'd love to hear about it in the comments below. Thanks for watching, and I'll see you in the next video.